Oh, crap. Howdy, howdy.
Morning.
Good morning.
Nick, are you on? Or anyone on from Rocket Dollar that's part of his team? Okay. Well, gosh. I will be right back. Yep, all roads lead to the same place. Okay. Hey, welcome, welcome, welcome. There's our fearful leader.
Hello there.
Howdy, Daniel.
Hello. I am not logged on as the host presenter right now.
Says your host.
Get in. Let me try again to see if I can join and give you host version.
It says your host, Daniel, FYI.
What's that?
It says you're a host, FYI.
Oh, it does. Okay, great. I will try to make you host then. How do I do that?
I see people joining, Daniel, but Nick says he's like connected and says it's waiting to start. So
You've got the other link then. You need to email him the URL for this meeting. He's got a different meeting link. I need to fix that in my process. The host gives a unique meeting link, and then I need to send him this one.
I see.
Join with the wrong link. I'm not sure that I can give you hosting abilities. Oh, I can. Here it is. Through the mobile app.
I got it.
All right. Hello, everybody. I'm probably about to lose my data signal. I'm in Southeast Idaho at the moment. I hope you all have a great meeting.
Enjoy. Thanks.
Cheers.
Hi, how's it going?
There we go. Hey, Nick.
Hi. What's
Hey,
happening?
Sorry about the confusion. We've got there's a couple of links that Daniel ends up generating per meeting, and we usually have a bit of this. Some end up on one, some end on the other, and he's got it in his list of stuff to go fix.
Cool. No problem. Hey, everybody. Hope you guys are doing well this afternoon. Have some nice weekend plans and aren't roasting like the rest of us here in Texas.
I'm roasting in Arizona, so I'm with you.
That might be worse. Do you want me to share my screen, Glenn? I'll go ahead and get started.
Yeah, please, if you want to get it queued up, and we'll give it about till about 5 or 6 after before we get going. We've got folks joining in the
Yeah, no
first few
problem.
minutes.
And this is recorded, right? So
It
if
is,
anybody
yep.
needs to replay, they can grab it.
That's right.
Fantastic. Hope you guys want to hear about retirement today.
More than you could probably imagine.
Not a popular phrase amongst normal people. But yeah, so the presentations are split into parts, right? This is part one. Might be a little bit basic, but we could likely venture into part two for some of the more advanced stuff, or even I'm happy to answer the most random questions you can throw my way.
Fair enough, Nick. And you said style-wise, you said you've got a few folks on with you, so if they can monitor some of the chat, for questions, or do you want me to queue them up to you and redirect them back to you? How would you prefer?
Well, if there's a Q&A going on in the chat, or like a Q&A that's popping up, whatever is, I guess, easy to answer from just a response, that's fine. But if you don't see anybody answering it, I'm happy to if you want to throw it at me, that's fine. I can field whatever it is you're going to be sending my way.
Got it. Fair enough. Sounds good.
We'll try to keep some of the questions to more of a broad question instead of the more personal. Hey, I have this type of account. I'm going to do this type of investment. What would you advise me to do? That I can't really do. So just a heads up.
Yep, we're here for generalized education and how we can utilize this as a tool for our investing arsenal.
Great. Let me know when you're ready.
Fair enough. Those of you joining this week, you'll notice that I'm not Daniel. I'm not trying to play Daniel. He's off playing in Idaho somewhere, camping and having a great time. So he'll be back, I think, next week. In the meantime, if anyone has any future topic ideas that they're interested in learning about, please throw them in the chat. And otherwise, we'll give it about another, I'd say maybe 30, 60 seconds, and we'll get started. Seeing the level of participants joining starting to taper off. All right, looks like we're getting a slow down. Well, let's go ahead and get started. So welcome to the Alternative Investing Club. This week, we're joined by Nick Gonzaga and his team at Rocket Dollar. And they're here to talk to us about self-directed IRAs. He's got over 2 decades worth of experience and managing over $500 million in institutional retirement accounts. And so he is your person who knows the ins and outs of all the security markets. Going to talk with us about how, when, why, where, and with whom to use, and how they can be useful for us in a variety of investing. So take it away, Nick.
Thank you, Glenn. Yes, I have a few years of investment experience, a little bit newer on the self-directed IRA, but Rocket Dollar is a fintech startup, so we're drinking from a fire hose over here. I've learned it a lot really fast. Don't worry, we're not here to solicit you, just to give you some information and education. So as I mentioned before, you can see my screen, right, Glenn? Everything looks good?
Yeah, all looks good. And we're
Okay,
recording.
great.
Everything's all great. Hopefully all set.
Fantastic. We'll get it moving. So this is going to be Self-Directed IRA Basics Part 1. These slides tend to lag a little bit, so if you're wondering why isn't the slide moving, it's probably because my computer's slow. So just taking a look at the agenda, it's going to be a real quick introduction on me. Then we're going to talk about some reasons for a self-directed IRA. You probably already know why you would want to do one. Rollovers, transfers, contributions, differences between what a traditional IRA is and a Roth, and some product types. So there's a couple of different ways people like to do this, and we'll talk about that at the very end. If we have some time, maybe we can get into different types of investments. So about me, I am a California native living in Austin, Texas. I've been here about 15 years. It's gotten extremely hot. Still not used to it, but before I was with Rocket Dollar, I managed about 500 million in institutional assets with retirement companies, or not retirement company, a retirement company, and multiple plans, right? So some of my plans were around 200 million. Some of them were much lower, in the 10s and 20s. But I was the person who was responsible for talking to the investment committees about their 401k plan. I got my licenses back in 2006. Can't believe it's been that long. I jumped into the industry around 2003 out of college. So that being said, we'll go ahead and move on to reasons you would want to do a self-directed IRA. Right off the top, there's three that we can think of. You want to look at the tax deferral and compound interest. Those two they're going to be in any IRA, right? And it doesn't matter what. It's self-deferred. Compound interest is fantastic. And then you have tax deferral, so you're not going to get taxed until you start taking money out. You have long-term investments, and then specifically the self-directed IRA, anyone can invest in almost anything. So I mentioned a couple of the highlights on tax deferral and compound interest. So when you go to make the investment and sell it, there's not going to be any capital gains, nothing on the dividends and interest. And we do get a lot of questions because some investments will kick off K1s, right? Well, that's fine, but there's really nothing you need to do with the K1. You just put it in a drawer, keep it for later, because it's a tax deferred vehicle that you're investing with. The only time you're going to get taxed is when you start taking money out and using it for personal expenses, right? So as long as it stays under the umbrella of the IRA, you're fine. Shouldn't be any tax consequences. As I mentioned before, capital gain tax does not apply. Taxes only apply as ordinary income when you start taking money out. If you have a Roth, best thing about Roth, I think most people know this, is it can be potentially tax-free. And I say potentially because there's two rules to a Roth that you have to abide by in order for your earnings and the contributions, the money that you put in, for it to be tax-free. The long-term investments part of it, that's mostly because in terms of retirement, you're really not supposed to take money out until 59 and a half. You can, right? But you're going to get taxed. So most people try to avoid that. So there's about 20 to 30 years for the retirement investment cycle of an IRA. When you're doing private market investments, a lot of times the short term could be anywhere from 2 to 5 years. And then on the long term, you're looking at 7, 10, maybe even longer than that if you're holding pieces of real estate, right? It just depends. But all the money that's going to stay in there, it's going to compound, doesn't come out. You can roll it into another investment if that particular investment closes, matures, or you get enough dividends and income in there to do something else with it. I did mention taking money out when you're not 59 and a half, right? So if you're younger, you're going to get hit with a 10% penalty fee. That's just something the IRS imposes, and I don't know why the magic number is 59 and a half. It's just always been that. So whenever you take money out, if you don't want to get hit with the penalty tax from the IRS, just make sure that you wait until you're 59 and a half before you take money out. Now, this is probably the most attractive part. Anyone can invest in almost anything. Really, it's non-publicly traded assets is the focus of a self-directed retirement account, right? If you want to do treasuries, if you want to do stocks and bonds or ETFs, you're going to do that in a brokerage. Self-directed account is really not the place to invest in different types of publicly traded markets. I see a question that rolled in. Can you ignore the K1s on a Roth self-directed investment as long as it's in a self-directed IRA, meaning it's going to be in a tax-deferred vehicle, right? So there's really nothing to report on as far as taxes go. And this is specifically towards something like a K1, or there's 1099 dividend interest that come out. You don't really do anything with that because it doesn't apply inside an IRA. So yes, you can ignore the K1s unless there's some unforeseen circumstances that I'm not aware of in a personal situation, but in general, yeah, that's fine. But going back to anyone can invest in almost anything. We do see a lot of real estate type assets, right? We answer a lot of questions on can I use my IRA for a house? Can I use my IRA for multifamily? Can you just self-storage? Almost any other kind of real estate. And there's so many different types that I've found out recently. And the term any IRS allowable investment, well, the IRS doesn't necessarily say this is approved. They'll say you can't do this, right? So if it's like an S corp, which I'll get into later, but an IRA isn't an approved, I guess, owner of an S corp, so it's a prohibited transaction. But in terms of doing an investment that's just out there in the private markets, you can, if you know someone that has a deal and you're friends with them and they have a company, yeah, you can potentially invest with them with a self-directed IRA. You just have to find the right provider, the provider that works with you the best, one that you like, one that fees aren't overwhelmingly expensive, right? So I think I covered a lot of that. I clicked the button, but it's not moving. Let's click it again. There we go. So just in sum, 3 main reasons, but we can roll on over into rollovers and transfers. This is tricky for a lot of people because you just don't get a lot of information about how IRA money works, right? In general, when we talk about doing a transfer, it's mainly from an IRA account. A rollover is from an employer account. In a lot of cases, you can move money from an employer account. It just depends on what the plan documents for that employer will say. So there could be a provision where you can do what's called an in-service distribution. That provision could also be eliminated from the plan documents. So it's always going to depend on the company that you work for and how they set up their 401k. In general, once you leave that company, you can always do a rollover. It's called separation of service. And whenever you do a rollover from a 401k, it's always going to be the pre-tax money goes to the pre-tax IRA. A Roth contributions, which more plans have Roth capabilities to do a Roth 401k contribution, that'll go to the Roth. So you always want to keep the money types in line. I mentioned briefly the IRAs and how they go IRA to IRAs, a trustee to trustee transfer. Well, a lot of people don't know you can do partials. So you don't have to move all of the money in an IRA. If you're doing a transfer, you can move however much you want. And then also there's this question of what about the 60-day rollover? I want to make sure to get it in within 60 days. That doesn't apply when you're doing an IRA to IRA, a direct transfer. That's only going to apply in what's called an indirect transfer. So if you take the money and put it in your bank account, that's a distribution, right? There's going to be a 1099 that gets generated. The IRS is going to know about it, and they're going to send you a love letter saying, hey, you owe us taxes on this. Well, if you move it into another retirement account within that 60 days, remember, you took a distribution, you didn't do a transfer. You have to make sure to put that money back into a retirement account so that the other custodian can send out what's called a 5498, or we just call it a 5498. That's going to offset the 1099-R that gets sent out. A lot of this is probably a little bit more technical, but it happens all the time. And we try to encourage people to do a direct transfer as opposed to doing a distribution and then putting it into a plan later. You can only do the indirect contribution once a year, or the indirect rollover once a year.
Hey Nick,
Sure.
Reddy's asking, maybe the bottom line definition difference between a self-directed IRA versus a non-self-directed.
Sure. I think it was a little bit, it might have been a little bit vague on the slides earlier. The main difference is that the traditional IRA is a brokerage product, right? And there's another slide in here later that goes in more specific detail. But the self-directed IRA is termed self-directed because you're the one that's doing everything. Real quick, the pros and cons are more along the lines of, if you're doing a traditional IRA at a brokerage, that's easy, right? We're gonna click, and buy this ETF. or you have it with an advisor, and the advisor is saying, hey, I think we should buy, we're going to allocate your portfolio, and this is how we're going to do it. And usually you either say, okay, or I don't want to do that. But in general, traditional IRAs are the brokerage products that are like Fidelity, Charles Schwab, what have you. Self-directed IRAs, we're not the only player in this little niche of the market, right? There's Equity Trust, there's Pacific Premier, there's Alto. Everybody's a little bit different. Everybody has a different type of structure, but their main focus is non-publicly traded assets. They may have capabilities to do brokerage, but that's not their focus. Their primary focus is to maybe allow you to do some individual crypto investing on an exchange. Maybe it's real estate, like I mentioned before, or maybe it's something like a pre-IPO. So something that hasn't gone public yet, that's going to go public, and people want to be a part of it before it hits the secondary market for trading in a brokerage. Hopefully that answers your question.
Yes.
Great. I think I had something else come in here, but okay, we're going to go ahead and move on. There we go, rollovers and transfers. So briefly, I mentioned money types before. So Roth is post-tax, right? And traditional is pre-tax, and it could be a simple, it could be a SEP IRA, qualified plan. If it's the term qualified, then that means pre-tax. Non-qualified means it's been taxed at some point. So you can move any qualified money, which is pre-tax, to any pre-tax account. So if you have a SEP, you can move a SEP IRA to a traditional IRA. If you have a 403B, that's also pre-tax. Actually, there's two types of 403B because that's an employer plan. You can do a Roth 403B or pre-tax 403B. As long as it's pre-tax, it can go into an IRA. So you want to just be mindful of that. You can't combine them unless you want to pay taxes. So we do get that question a lot. You can't combine anybody else's account with your account and vice versa. I is for individual, so individual retirement account means that it's just yours, or it's just whoever owns it. It's only theirs. You can't put the money together without getting a notice from the IRS. Contributions. So contributions in an IRA aren't fantastic, but they're not too bad either. You can do 6,000 or 6,500. 2022's since gone. There's no 22 contributions anymore, but for 2023, it's that catch up of 1,000 if you're 50 or over, or 6,500. This is going to apply across all of your IRAs, right? So you can't do 6,500 in each IRA that you own. It's across every single one of them. So pick your favorite if you want to do that. And 401ks, much different. So we do offer solo 401k contributions, but contributions also apply to employer plans. So for 2023, it's 22,500. That's just for the employee deferrals. If you're 50 and up, you get an additional 7.5 thousand. So 7,500 can go in there. And then your employer can put money in there, right? So that's the match. Oh, we got a mega backdoor. That's like part 5 in terms of the presentations that we have. Actually, I think it's part 3, but we do talk about mega backdoor, and I can answer those questions later. And so all in all, you're looking at $66,000 for a 401k if you have the revenue to do that, right? It's fantastic. It's a great way to sock money away for retirement. If you're 50 plus, you're looking at $70,000. Now, when someone has their own business, no employees, they can set up a solo 401k. And we often get these questions about solo 401k versus SEP, and that's a little bit later in one of the presentations as well. I guess the biggest pro to having the solo 401k is you can choose to do a Roth contribution, right? So you can choose pre-tax or you can do Roth. it doesn't matter how much money you make to do a Roth. If you do a Roth IRA contribution, obviously it's going to be lower, but also you get phased out at a certain income point. So a solo 401k is a good way to get around that. Continuing on. So some of the main differences and also similarities. If we look in the middle, the Roth and the IRA, the contribution's going to be the same, right? Tax filing deadline is the deadline for the contribution for the following year. So for 2023, the last contribution you can make is going to be in April, right? April 15th is your drop dead date. Unless you do a filing extension, then it's longer, but for the most part, it's going to be April. You can't take money out anytime, you're just going to get taxed. And then the earnings are going to be tax deferred. I see some questions coming in real quick. I'm just going to touch on a couple of these parts on the slide, and then I'll come back to the questions. So the Roth being post-tax, it's taxed up front, right? So you pay the taxes up front so that you don't have to pay taxes on the back end. The two rules that I mentioned is that you have to be 59 and a half, and it also has to be in effect for 5 years before you take the withdrawal. So you have already had to make the contribution 5 years before you take the money out for the earnings and the contributions to be tax-free. If you don't obey those rules, you don't get taxed on the money you put in there because that's already been taxed. You get taxed on the earnings. So if you made any money on it, that's going to get taxed at whatever your interest or whatever your tax rate is, right? And then if you're under 59 and a half, you're going to get hit with that penalty fee. No required minimum distributions. So that's also kind of nice. Traditional.
Question on the 5-year rule.
Yeah, go ahead.
The 5-year rule, is it 5 years since you started the Roth, or is it 5 years since your last contribution?
5 years since you started. And it's not anniversary, right? So it doesn't track if you made it on June 1st.
Mhm.
It just says you made it in 5 years ago based on January 1st. So it's calendar year after the 5 years. Does that make
Okay.
sense?
Yes. Thank you.
Sorry, Nick, just one more thing. And that's based on the first Roth IRA you created, right? So you have multiple Roth IRA, it's only in the first one, or is it individual one?
It's going to be, it depends on the IRS really, but in most cases, when people set up their first IRA, they usually stick with it, and it's going to be on that contribution in that IRA. So that's a little bit more of a detailed question. I want to say it's going to be on the first IRA you open, but if you open it at different places, each different place is going to have its own reporting, right? If you have a Roth IRA at Fidelity, they're going to say, Mr. Smith put money in on this date. If you open an IRA at Vanguard, they're going to say, Mr. Smith put money on this date. And then when they submit your forms to the IRS, it's going to be based on that date. So you don't need a whole bunch of Roth IRAs, honestly. You could move them all to one and just keep one. It just depends on what you want to do and where you want to go. Yeah, that's a little bit more of a complicated answer, but I think in most cases, it comes down to who the custodian is and how they're tracking it. So let's get to some questions. I think everybody knows how the IRA works in general, right?
One question, what is, you said you can only contribute to traditional Roth depending on the income bracket. Where does this cut off?
I don't know the numbers off the top of my head, but I want to say if you make over 200,000, you either can't contribute or you're getting phased out, and that's on a Roth. So in the terms of terminology, the traditional IRA means pre-tax, and Roth IRA is the post-tax, right? So it's definitely based on income, gross adjusted income. And if you type in Google, like Roth IRA phase out, you'll be able to get the different tiers. But like I said, I don't know them off the top of my head. I'd have to look them up. Sorry. So going to the questions that we have in the chat real quick. Until you can do a mega backdoor. Yep. They probably offer after-tax contributions too. I don't know. But a lot of plans, especially much bigger plans, will allow that. Have I tried using, I'm just going to read it out loud. I have tried using my self-directed IRA to purchase ownership shares in an entity I own. This triggered some level of self-dealing with this. Yeah, that's a very specific situation to that person's particular investment. Yeah, so we can talk you through something like this, but in a lot of cases, you definitely have to be careful when you're investing in the company that you own, because it's based on ownership levels. In general, we have the green light, yellow light, red light. It's going to be 10% and under. In most cases, it's going to be a green light to invest in that company. If your ownership is 10 to 50%, you're looking at a yellow light. And after 50% and up, that's usually a red light, a no-go, unless there's some circumstances I'm not aware of. But if you want to give us a call at Rocket Dollar, we can talk to you about it. We might be able to help you, but it really just depends. Movements of Roth IRA transfers. Don't reset the 5-year requirement, correct? In general, no, not really. But again, it kind of depends on the custodian. Pre-tax Roth means it's taken from your paycheck. So pre-tax, the term pre-tax and Roth don't go together. It's only going to be pre-tax because you haven't paid money on it, right? With the Roth, you haven't paid money. You haven't paid taxes, is what I mean. With Roth, you've paid the taxes. That's really what the difference is. And it can come from your paycheck. So if you're doing a deferral into the 401k, the deferral is going to go into the 401k. And if you do pre-tax, you're not going to get taxed. If you do Roth, you get taxed before it goes in there. So then when you take the money out on the Roth, eventually, hopefully, you're not going to have to pay taxes on it. And then on the traditional, when you take money out, you're probably going to be in like the 10 or 15% tax bracket because you're retired, hopefully, if you're taking it out after 59 and a half. That's really the purpose of the difference between the Roth and the traditional. If you think that that taxes are going to go up and you would rather pay them now, then the Roth is probably what you would want to do. It also depends on your tax bracket and how much you want to pay. So I hope that helped. So going into the product types of the self-directed IRA. So there's a few ways to do this. In general, there's what most people are familiar with is a direct custody type account. It's also referred to a few different things. People can call it an IRA trust, but that's also terminology for another type of product. I'm not going to get into that. But the main difference between all of these is if you have a direct custody IRA and it's with whoever it's with, the custodian is going to review documents before the investment is made. Some people don't like it. Some people do like it, and they find that to be a little bit more comfortable for them to do. But if you happen to do real estate where it's more transactional, you may want to do something that's like an IRA LLC or a checkbook IRA. Now, there's a couple different ways to set that up. With Rocket Dollar, we basically create the LLC for you and then set up a bank account and the IRA. So you're essentially just having one place to do it, right? We have your bank, we have the LLC, we're renewing the LLC for you. Now, with other people, they go and create the LLC themselves and have an attorney do it, and then they'll find a custodian to hold that LLC. And then they'll just create an LLC bank account somewhere. The mechanics of which can be pretty sophisticated. So you plan on doing that, just make sure you're really checking all the boxes off and crossing the T's and dotting your I's. So. And I'm not here to sell you, but just so you know, pricing is different everywhere you go.
Mhm.
I just say be an informed consumer. Again, we're not the only shop out there. In terms of our pricing, it's pretty competitive. There are other places that maybe they don't have as high as a one-time setup fee. Maybe their annual fees are higher. Maybe they charge per investment you do, or they have what's called an asset-based fee. And it's a percentage based on how big your account is. Everybody's different. So just make sure that you're paying close attention to a fee schedule or some kind of pricing chart. So that's it for part one. And we'll roll into the questions now.
Mind
Get a little
going
bit
back to that previous screen with the fees?
Yeah,
Just-
sure, no problem.
Yeah, I pasted a question in the chat. I don't know if you
Oh, let me check.
can.
How long does it take to transfer rollover traditional IRA rocket? So it depends on which level you get. Gold's going to be a little bit faster than the silver. On average, I would say it's plan ahead, at least 3 weeks if you're looking to make a self-directed investment, because you do need some extra cushion time. We try to move as fast as we can, but it's retirement money. Retirement money doesn't move as fast as bank account money. So just in terms of setting up the account, it could be 2 to 3 days. If you're catching us on a Monday, setting up the account could be done by Tuesday, Wednesday. But then you also have to fund it. It's going to be faster coming from an IRA than it is coming from an employer account. Employer accounts are always submit the distribution request, print the check, and put it in the mail. So far, Fidelity is probably the fastest that we've seen. It's usually 3 to 5 days to get that money over. But yeah, it could take a couple weeks from open to fully funded and ready to make that investment.
I see. Okay, and then is the 600 per investment or just a one-time charge? So let's say I roll over my IRA to Rocket and I do an investment, I get that money back, and then I do another investment, to continue to earn return on the same amount of money over and over. Do I redo the 600 or every time, yeah?
Definitely not. That would be a terrible business practice to charge somebody every time they made an investment. No, and so it's really paperwork, right? So if we're setting up the account, and there's I gave Daniel a coupon for $100 off. I can make sure he sends it to everybody. If you want to give me a call at some point, we'll generally give $100 off to anybody who calls into the line. The one that we have right now, I'll just throw it out here. It's Delta 10, DELTA, all caps, and then the number 10. So that being the case, it's a one-time fee. It's mostly for paperwork and doing the KYC AML and making sure we can get the self-directed IRA set up. Not a lot of people need the gold. Silver's fine. It just depends on what type of investor, what type of person you are. I'll always say, paperwork is everybody's Achilles heel, right? So if you're not great at paperwork, maybe gold it's more handholding. The main difference is level of service. So if you're a gold member and you need to give us a call and we'll be able to help you on the phones. Silver members, it's just make an appointment, and most of the time you can get an appointment the next day. If it's early in the morning, there's usually some later in the afternoon, unless it's a crazy, everybody needs to get their 401k open by the end of the year. Busiest times are in December, last couple of weeks of December, and right around tax time. So if it's not those 2 time periods and you're not in a really big hurry and you're really good at planning, and paperwork is fine, you're not bad at paperwork, then silver's just fine, and silver's fine for most people.
Mm-hmm. And
In
that
turn, oh, go ahead.
LLC, oh, sorry, the LLC creation, do you guys pay state filing fees or what, or fees with that, or? is
Yeah,
it-
it's a Colorado LLC, right? So, and that's how we streamline it. So if it doesn't matter what state it's in to you, depending on what you're doing, you might have to register as a foreign entity. But if you're just doing private placement investments and syndicates, you generally don't need to register as a foreign entity. But yeah, the LLC is created in the state of Colorado. We cover the filing fees and the renewal fees on that, so you don't have to.
Okay,
And then there was a follow-up to the gold and silver in terms of account balance. It's entirely up to you, right? I would say, depending on what your account balance is relative to how much you're paying to open the account and have a monthly fee, it's not like a 1% fee, right? So if it's 500,000 or 600, whatever it is, it's not, we're not taking $5,000 a year on that account. We're just taking our monthly administration fees.
Maybe we can go on to part 2, and if others have like more specifics on account creation and desire, they can contact you separately if that works out okay.
Yeah, absolutely. I'll be happy to. So I'm going to switch because this is a whole remake of our presentation. We just got it out earlier last week. Our other presentation is fine. It's not as glorious as this one I think is. So give me just a minute. I'm going to stop sharing, flip my screens, and then I can continue going. Right. Everybody should be able to see that screen. I just jumped right off into that main slide right there. Okay, so I mentioned investments, publicly traded assets. So that's what you would do in a traditional, a brokerage IRA, right? So instead of traditional Roth, just brokerage IRA, because you can have a traditional or Roth brokerage IRA. But that's the options you would have. All publicly traded securities. And examples, Schwab, Fidelity, TD Ameritrade. The self-directed IRA, as I mentioned, real estate, and of course the list. Offices, storage, parking lots, resorts, multifamily, condos, apartments, almost any type of real estate, right? And angel investment startups. I mentioned pre-IPO earlier, private common stock, safe notes, loans, private debt, private credit. Private debt has become a little bit more popular lately. Promissory notes. So if you know someone who wants to borrow money, and you're okay writing up a document and lending them some money, and they pay you a set amount of interest that you agree with, that's also possible. Growth financing, commodities. Most people are familiar with commodities in terms of gold and cattle, but there's also agriculture. When I say gold and cattle, I meant gold and silver because I saw cattle there. So yeah, people invest in beef. Securitized assets. Securitized assets is a general term. That could be artwork. So there's a company called Masterworks. They securitize art. There's a company called Vint. They securitize wine and spirits. And then there's a few other ones. There's another one called Diamonds. They securitize diamonds. So you wouldn't be able to own those types of assets in an IRA unless they were securitized. So don't use your IRA to buy gems, wine bottles, and works of art, or any collectible. Those are all prohibited. And lastly, cryptocurrency. Prohibited transactions. So in light of this being education, I have a hyperlink here. It clicks to our website. It's a knowledge base. I'll show you in a minute, but just in general, Don't invest with yourself. So don't buy or sell from yourself, your spouse, your kids, or your mom and dad. Siblings, cousins, friends, that's fine. Those are not disqualified persons, but close relatives are. Your financial advisor, they are a disqualified person. Beneficiaries, I mean, you guys can read this. The more, I guess, gray area ones are the ownership that was mentioned earlier, right? If you own 50% of the company, don't do it, not in your IRA. If you own less than 10% in your rank and file, that's probably fine. Here is, let's see, if you have, I think this is going to go to who is a disqualified person. So we have articles on our website that basically tell you what you can and can't do. I think this is the reason why I put the link in here, because it's a nice little family tree of what you can and can't do with the people that you're related to. Now, in terms of the assets that you can't own, S corp, the IRA doesn't qualify it as a shareholder, so you wouldn't be able to do that. Insurance, insurance is all after tax. Oh yeah, I can do the link in the chat. Can you please paste that link in the chat? No problem. Here you go. Collectibles, as I mentioned before. NFTs, definitely don't do that. Not because they're necessarily that type of investment, but because that's considered a collectible in terms of the IRS. It's digitized artwork collectibles. All right. Oh, this is the difference between, sorry, my little control panel is in the middle of that screen, so I just have to move it. Okay. We do get questions from time to time, just people wondering if the IRA is the same thing as a 401k. It's definitely not. So the IRA isn't company-sponsored retirement plan. A 401k is, 403b is. A thrift, TSP, I'm forgetting the letters, what they mean, but it's a thrift savings plan. That's what it is. All of those are employer plans. They're not IRAs or also group plans. Can one choose if yeah, you can choose if it's going to be a traditional or Roth. It's entirely up to you and what type of money you already have, right? So if you have a Roth IRA, you want to open a Roth SD IRA, great. If you don't have a Roth IRA and want one, but all you have is traditional IRA, you can convert some of that money to a Roth if you don't mind paying taxes on it. And now you have a Roth IRA, and you can do a self-directed Roth IRA. So absolutely, you can do that. You can't have multiple IRAs. A lot of people do. A lot of people have more than one. You don't need more than one, but you can have more than one. Yeah. Traditional pre-tax Roth, catch-up contributions age 50 and more. Let's see. Another question came through. If you do a solo 401k for your LLC, can you roll that over to an SD IRA? You don't need to, really, because you could move your solo 401k to a self-directed solo 401k if you already have a solo 401k. It gets way more technical if you have employees. The best, I guess the best way to put it is to have a solo 401k, you don't have employees or any W-2 employees. You could have independent contractors and whatnot. And then you own the business yourself. Nice little tidbit, your wife, the IRS allows for your wife to become a participant of that solo 401k, but that's the only exception. The only people that can have a solo 401k is the business owner and their spouse. So kids, everybody else would not apply. 401k basics tied to a sponsoring company, like I mentioned before. Much, much higher contributions, and everybody knows about the employer match. Oh, I missed something. The taxes. Yeah, I mentioned that earlier though. So just a reminder, if you take money out before you're 59 and a half, there's going to be a 10% penalty imposed by the IRS. So it's really, if that's going to be your last ditch effort to get money out of your IRA and you have no other choice, you can do it. You'll get taxed plus 10%. Thanks, Glenn. Glenn let me know that we have 12 minutes here. If you want, I can just blast through. There's only a few more slides left. Required minimum distributions, if anybody wants to know about that. Secure Act changed some of the rules. You don't have to do it if you have a Roth. The age is 72 now. It used to be 70 and a half before. So that might affect some people. Oh, if you do have to take a distribution, a required minimum distribution, just make sure you do it. Most people do it anyway because they're going to be taking money out of the IRA. But if you don't do it, then yeah, the penalty is pretty stiff. It's 50%. So going back to the solo 401k information, small business owners, no W-2s, husband and wife, catch-up contributions if you're 50 plus, those are huge. Separate lines of businesses. So we have talked to people who maybe have one company and then a bunch of other companies, right? If you have a solo 401k and you have more than one company, the solo 401k is going to get tied to whichever one you choose that has the revenue. It's to follow the money, right? So if the company is making revenue, that company can defer that that salary, or the business owner can defer the salary into a company plan. You wouldn't be able to have company A and company B and then have a solo 401k that has both of those companies. Solo K is tied to one company. You can choose pre-tax, Roth, and after-tax. A lot of people don't really do after-tax, but almost all of them will do pre-tax and Roth. Do you have to move your distribution into a regular account? So if you're doing the required minimum distribution, it has to get taxed unless you have some sort of estate planning. That's more of a specific way of doing it, right? Talk to an advisor about that or a CPA. But yes, in general, if you are doing a required minimum distribution, that goes into a bank account or any other type of non-qualified / taxable account, and it is taxed. Contributions, just a reminder. Employer contributions for the previous year, that changed a little bit. There is provision for sole proprietorships that haven't had a 401k before. Not going to get too much into that, but it is a little bit different now. So Secure Act 2.0 changed some of the rulings. Before it was, if you had a solo 401k, wanted to make a contribution after the end of the year, you could only do employer contributions, not employee contributions. But if you haven't had a solo 401k before and you're sole proprietorship, might even apply to other lines of businesses, but I know for sure sole proprietorship, you can generally set one up, but I always say talk to a CPA about that. They're going to know more about it than I will. And then the contribution limits, same thing here. We have another article that talks about how to maximize your employee or your 401k contributions, solo 401k contributions. Basically, you're able to sock away over $100,000 between a husband and a wife fairly easily. Of course, you would have to have the revenue in that company to do it, but it's certainly possible. Just with the high contribution limits that these accounts have. Just to follow up to that slide. Oh, here's I'll put this in here too, just in case. So this is the article I was talking about. So here we update the contribution limits, and then some of the basic rules. Might be a little bit difficult to see on your screen, but of course you can click on the link and get more information. But we also provide some examples, right? if you're making X amount of money. Okay, great. So that's it for part 2. Now, if anybody has any other questions.
Hey, Nick, when you're when I'm doing an investment inside of SDIRA and there's this IRA LLC, if I've got multiple investments, am I creating an LLC for each of them so they're isolating, or is there a risk of the account across multiple investments?
So let's see how I can tackle that question. So in general, the LLC isn't necessarily created for any kind of shelter. The IRA is more or less sheltered from getting sued, right? Basically, you can't take somebody's retirement account. But it's more along the lines of you are the sole managing member for this disregarded entity. So it's not a business. A lot of people automatically hear LLC and think it's a business. It's not. It's more like a shell account. In that the LLC is doing the investing, right? So that's the owner. But as you are the managing member of the LLC, you are approving the investments that the LLC is doing. And when you make the investment from the LLC, you're not making an LLC for each and every investment. You just have an LLC that has the money, and then the investments that you make are all owned by the LLC. Yeah, somebody finished my sentence. That is correct. So if you have already invested using an LLC, it's very much the same. The only difference is you're using retirement money instead of your after-tax money. Does that make sense?
Yep,
Yeah.
thanks.
Yeah. So like I said before, this is very fish out of water. A lot of this stuff is fairly sophisticated. Once you start to get familiar with it, it's not as hard as it seems. So going to the questions, starting with the bottom one, Brooke, thank you. So the penalties of 50% tax on the amount not withdrawn has to do with the required minimum distribution only. So if you're 72 years old and you didn't take money out the year that you were supposed to take money out, so the IRS could tax you for your required minimum distribution, then yeah, they're going to penalize you 50% on the amount that you should have taken. Otherwise, it just would have been regular income, right? The 15% or whatever tax bracket you're in, it would have been. They really want that money, so they haven't taxed you on it the entire time. That's the reason why. So for every transaction, an IRA LLC will be created, and it is including. So you're only going to pay one time to set up the LLC, and you're going to use the LLC whenever you make the investment. So it doesn't matter how many times you send money out, because that's really the only thing the LLC is doing. It's sending money to the investment. It's not getting created each and every time. That would be a nightmare. Just one LLC. In general, if it was my LLC, it would be any Gonzaga RD LLC, and then my RD LLC could own 20 investments, or however many times I wanted to invest.
Hey, Nick, I know while we're running through the last few questions here, if you had a slide that had your contact information so people could reach out to you, that might be something they could capture in parallel, or if you want to paste it into the chat, maybe your email or something for folks to be able to reach out to you.
Yeah, sure thing. We are available at info@rocketdollar.com. We wear a lot of hats. We're a startup. I cover a lot of areas at Rocket Dollar. So you could just mention me by name if you send info@rocketdollar.com an email, or you can call me. I answer the sales line as well. And I do get questions all day long. Some of them are really easy, and that's great. And some of them are really off the wall, bonkers hard. So whichever way they go, it's fine. Educational podcasts, articles, or books. We have a podcast, and it covers a ton of different financial information with some of the founders. It's rocket your dollar. Our CEO talks to a lot of other fintech startups. It's really interesting. In terms of other podcast articles, there's so many. We do also have a YouTube channel, so there's also a bunch of stuff on our YouTube channel. So you can take a look at those. Thanks, Glenn, sharing that.
I know we're in the final minute here, so
We can stop the recording if people want to continue to ask questions. It's up to you, however you want to do it. I'm okay to keep going.
Most of us have to probably drop off. There's some that are retirees that are on here or have left the company, but a lot of us are still working inside Intel and got a stop at the hour. So we can certainly hang out for a couple minutes if needed. Otherwise, I'd ask everyone to take themselves off mute and say thank to Nick for coming in and presenting out on SDRAs for us.
Sure thing. Let me get to this last
Thank you,
question
Nick.
from DJ. And I'm very happy to help. Thank you for having me. Really appreciate it. DJ, you're welcome. Thanks for joining.
Thank you.
Thanks, Nick.
You got it.
Thank you, Nick.
You got to tell your friends.
Everybody.
Thank you.
You're
Thank you.
welcome. More people need to know about this. That's all. Almost nobody knows what these things are and what they can do. Let's see. Could you do an umbrella LLC structure where the IRA funds the main umbrella and the sub LLCs? So you wouldn't need to do that. That would be more of a taxable structure where you're holding taxable entities under one main LLC. What you're really doing is just creating more LLCs, but not for any real purpose because the IRA already owns the LLC.
Well, yeah, but it depends on if you want to diversify into different investments. So if you want one for an ice cream shop and you want one for a salon and you want another one for real estate, that's what I'm saying. That's kind of where I'm thinking about it.
So you don't have to create an LLC for each investment unless you want to. Does that make sense?
Yes.
So
It just keeps things separate. So the question is though, could you do the umbrella structure and not have any issues within the IRA?
You would have issues. And the reason why is because an IRA can really only have one LLC because it's an individual, right? So if you think about it, it's just one straight line going down. It's you, the LLC, and then a branch of investments. Whereas you're more thinking about like a parent-child structure, corporate.
Yeah, within the IRA. So
you couldn't
the
do that in
IRA
the
only. Okay, so a structure where the IRA owns only one LLC, but that LLC owns other LLCs you couldn't do.
Oh, okay. So
that's the umbrella.
I
Yeah.
see what you're saying.
Like a holding company, right? So typically a holding company is what we called the main, and then the LLC says the subsidiaries
That's
underneath.
similar.
Is that what you're talking about? Yeah.
It's similar.
You could, and so I'll give you an example. Some people do multi-member LLCs after they create their LLC because they want to do something local, right? They have a Colorado LLC, and they live in Florida, so they want to have their own multi-member LLC. So they fund their LLC with their Rocket Dollar LLC, right? And now that LLC goes and buys whatever they're going to buy. But also, when you have this LLC, and you don't need it, by the way, you can have it, but you don't need it. You can do just a direct custody account if you wanted to, but you're basically just investing in different LLCs.
Yes.
So yeah, I misunderstood. Sorry.
The main LLC would be the one investing in those different LLCs though.
Yeah, so the main LLC is the IRA LLC.
Yeah.
Right? And now you're funding investments in these other LLC companies. Yes, that happens all the time. It's just an investment is what it is. Not necessarily creating new LLCs. You're just saying, I want to invest in this ice cream shop, and the ice cream shop is named ABC LLC. put money.
Well, yeah,
away.
you could also like have a rental portfolio and do a different LLC for each rental that you have, and
Yeah.
do that for liability limitations.
Yes, for each property. Yeah.
Yep.
Yeah, and I think I would create a separate LLC under my holding company for investments, just to protect it, and also to be anonymous. So if I did loan it out and didn't want to be listed as the owner, I have some, privacy that way too. I think that's one of the other benefits of having a holding company and then a private LLC underneath as what I would use to do the investments.
So there's a couple different ways to do that. If you're interested in having the anonymity, sure, you could do that. In some states, it gets expensive, right? If you're in California, you're going to be
Well, if you already
up.
have the holding company, it isn't. But yeah.
Okay.
Yeah, I wouldn't create another holding company, but yeah.
Right. Is the recording off, Glenn?
No, we're still.
Go ahead and stop recording.
Maybe we are. Let's see. Stop.